TWR Tech Video.
What is up, team? Chuck with Traders War Room. I'm back at you with another video. We got a tech video for you today, and basically we're going to cover divergence. Essentially, I saw a lot of divergence in the marketplace last week, and I want you guys to, number one, know what divergence is. Number two, understand how it affects the market. Number three, how to utilize it so you can make some money. And that's what it's all about, giving you a tool and the ammo so that you can go out there and attack the market. But at first, we got a class on Sunday, and I got a short promo immediately after this that I want you guys to watch. The class is going to be an awesome class. It's all about reading candles, reading volume, reading momentum, and making big money based off of those three factors. And I hope to see you all in class on Sunday. And right after that promo, we're going to get into the video. And as always, if you're ready, follow me and let's go to war together. Traders War Room, baby. Let's get it.
Plan your battles with Traders War Room Classes. Join TWR on 19 February at 1 p.m. Central Standard Time and learn to day trade using candles, volume, and momentum with guest instructor Diesel Trades. Quit stressing over the market, trading for losses instead of gains. With a heavy hitter like Diesel guiding your trades, you could be done trading, chilling 30 minutes after the bell, or stuck in a corner crying, thinking, well, I'm sure you can think of a few things. Join us on 19 February at 1 p.m. Central Standard Time and learn to be a killer day trader and only worry about one thing: how to count your freaking money. 19 February, we go live, and I can't wait to see you in class. Register online at traderswarroom.com/upcoming classes. Make the market bend the knee in 2023. Join TWR and bow to no one. Okay, so what is divergence? Well, divergence is when the price of an asset is moving in the opposite direction of a technical indicator, such as an oscillator, or is moving contrary to other data. Divergence warns that the current price trend may be weakening and in some cases may lead to the price changing direction. There is positive and negative divergence. Positive divergence indicates a move higher in the price of the asset is possible, and negative divergence signals that a move lower in the asset is possible. And this is what gives us dramatic shifts that can be extremely very profitable for us. So what does divergence tell us? Well, divergence in a technical analysis may signal that a major positive or negative move is upon us. And a positive divergence occurs when the price of an asset makes a new low, while an indicator such as money flow starts to climb. Conversely, a negative divergence is when the price makes a new high, but the indicator being analyzed makes a lower high. Traders use divergence to assess the underlying momentum of the price of an asset and for assessing the likelihood of a price trend reversal. Now, for example, investors can plot oscillators, and oscillators are the most common use to find divergence, like the RSI, which is by far one of the most popular ones that is used, and they put it on a price chart. If the stock is rising and making new highs, ideally the RSI is reaching new highs as well. If the stock is making new highs but the RSI starts making lower highs, this warns that the price of the uptrend may be weakening and you can see a dramatic shift. This would be an example of negative divergence. We'll go into detail on this a little bit later, but you can see here regular bearish divergence on the actual price action, and then the oscillator is showing you the correlation right there, to which eventually becomes the downward shift in the price action, giving you a very dramatic shift, equalizing out into extreme profitability if you catch it. On the same way here, catching regular bull divergence, and you can see on the RSI, you're making that lower high or the lower low on the RSI, and you get that dramatic shift with the extreme push on the price action to the upside. So then the trader can then determine if they want to exit the position or set a stop loss in case the price starts to decline. Positive divergence is the opposite situation. We just saw both examples of negative and positive in the last slide, but imagine the price of a stock is making new lows while the RSI is making higher lows with each swing of the stock price. Investors may also conclude that the lower lows in the stock price are losing the downward momentum, and a trend reversal may soon follow. Divergence is one of the common uses of many technical indicators, primarily off of the oscillators. Now, this cheat sheet is a great cheat sheet because it really gives you the 4 categories of divergence. And as you can see, each one has the price action associated with the oscillator. Right here, you have bullish divergence, you have bearish divergence, you have hidden bullish divergence, and you have hidden bearish divergence. And essentially, divergence is when the price and the indicator are telling you different things. And as we talked about with confirmation, that's when the indicator and the price or multiple indicators are telling the trader the same thing. Ideally, traders want confirmation to enter the trade, and while inside of the trade, giving them the understanding of direction of traffic. If the price is moving up, they want indicators to signal that the price is likely to continue moving up, and vice versa. Now, like everything else, this is not foolproof and there are limitations of divergence. So, it is true with all forms of technical analysis, investors should use combination of indicators and analysis techniques to confirm a trend or a reversal before acting on divergence alone. Divergence will not be present for all price reversals, and therefore some other form of risk control or analysis needs to be utilized in conjunction with divergence. Now, let's talk about technical divergence. So, in technical analysis, most indicators give 3 different types of trade signals: crossing over a major signaling line, crossing over a center, and indicator of divergence. Divergence occurs when an indicator and the price of an asset are heading in the opposite directions. So here's an example of the difference with something crossing over a major signal line. As you can see here, we have moving averages and we have a definite cross to the upside with price action moving to the upside as well. This would be a fantastic signal based off of crossing over major signaling lines. In the next example, we have crossing over a center line. Down here we have the tricks, and you can see that it's correlating with the main chart and the moving averages with the cross, giving that confirmation. However, in this particular block of instruction, we're talking about divergence, and you guys are going to get a lot of charts, hopefully breaking it down and what we're looking for with divergence. Of these 3 types of signals, you can understand why divergence is probably the most complicated, specifically for the newer investor or the rookie trader. So, when we're trying to understand technical divergence, we need to understand negative divergence happens when that price of the security is in an uptrend and a major indicator such as the MACD, the price rate of change, or the RSI heads downward. Conversely, positive divergence occurs when the price is in a downtrend, but the indicator starts to show the rise. Now, these are usually reliable signs that the price of an asset may be reversing. When using divergence to help make trading decisions, be aware that the indicator divergence can occur over extended periods of time. So, tools such as trend lines, support, and resistance level should be utilized as well to help confirm this trend reversal that you're seeing with divergence. However, understanding divergence can lead to some of the most profitable trades because it helps the trader recognize and respond to extreme price changes in the price action. It signals that something is changing, and the trader should be able to recognize and consider the options, whether that is to sell a covered call, tighten a stop loss, or, as we like to do in TWR, ride the wave. The problem and issue comes when our ego gets in the way of making those profitable trades. You must take the correct action based on what the price divergence is actually doing and telling you, and not what you think it may do in the future. All right, so we talked about this earlier, but divergences tend to either be bullish or bearish, and we saw that we have some hidden ones as well. But let's look at this chart right here. This chart gives us our price action, the oscillator, and the type of divergence that's happening. We can see in the first example, when our price action goes from high to a higher high, our oscillator goes from a high to a lower high, which equals bearish divergence. Now, on the other side of it, price action goes from a low to a lower low, oscillator goes from low to lower high, and that gives us regular bullish divergence. And you can see the hidden ones as well below. Now, we just talked about strength, and when we're talking about strength, there's a couple classes that divergence falls into. A Class A divergence is stronger than a Class B, and a Class C divergence is the weakest of them all. So experienced traders tend to ignore Class B and C divergences and just categorize them as simply indicators of choppy markets, and only take action to protect profit in periods of Class A. So the example here in the chart is this security is experiencing a prolonged uptrend. And I know you guys have heard me say this before. What goes up has to come down, and too much, too long definitely has a chance to reverse. And this is what it's actually showing. So experienced traders would realize that the price action is sloping down while the price continues to climb. And this is a classic case of great setup for divergence, because you're watching the indicators, you're wondering, why is the price action still going up? All my indicators are pointing down. And well, it's because we're getting divergence, and we have to expect that price exhaustion will happen and the reverse will eventually come. Now, this is a type of negative divergence that can be an early sign that the price of the underlying security may be reversing. If the price of the security breaks below the upward trend line, this will complete the confirmation and the trader will take a short position. Now, when we're talking about the types of divergence, they can either be bullish or bearish in nature and have been classified according to their levels of strength. We talked about this earlier. Now we're going to dive into it. Strongest divergence are Class A, exhibiting less strengths are Class B, and the weakest are Class C. The best trading opportunities are indicated by Class A divergence, while B and C represent choppy market and should be generally ignored, but day traders or scalp traders enjoy trading B and C because the choppy markets are what give the volatility such a great push in a shorter time frame. So when we're talking about Class A, we're going to talk about bearish divergence first. This occurs when the price rises to new highs, but the oscillator can only muster a high that is lower than exhibited on a previous rally. Class A bearish divergence often signals a sharp and significant reversal toward a downtrend, and Class A bullish divergence occurs when price reaches a new low, but an oscillator reaches a higher bottom than is reached its previous decline. Class A bullish divergence are often the best signals of an impending sharp rally. And here in this chart, I got a couple different examples of what Class A divergence looks like. Class B bearish divergence are illustrated by price making a double top when an oscillator tracing a lower second top. Class B bullish divergences occur when the price traces the double bottom with an oscillator tracing the higher second double bottom. And as you can see in the chart below, you got an example of both bearish and bullish Class B examples. And finally, Class C divergence with the bearish occurs when the price rises to a new high, but an indicator stops at the very same level it reached during the previous rally. Class C bullish divergence occurs when prices fall to a new low while the indicator traces a double bottom. Class C divergence are most indicative of a market stagnation. Bulls and bears are becoming neither strong nor weak, and so you kind of get that sideways movement with slight chop up and down. Now, let's talk a little bit on how divergences are formed. So, these are formed when there's a mismatch between the price action and the momentum measured by the oscillator relative to the price. Quite often, you will notice that divergences tend to occur near support and resistance level. Therefore, divergence trading can be used not only to time the entry into a trade with a trend, but it can also help you understand support and resistance levels. Here's a good illustration I found kind of explaining that type of thing with support and resistance levels as it correlates to divergence and utilizing the oscillator with, in conjunction, the price action, the trend lines, and the support and resistance. While divergences are broadly classified into four types, the underlying thing among all four types of divergence is that it shows price exhaustion when the oscillator fails to confirm the new highs or the new lows. Divergences take place in all time frames and across all frames. And that's important to know because if you're looking at it from a 5-minute time frame, you can utilize the 15-minute or even the 4-hour chart to kind of get a broader time frame sense of what has actually happened. Now, with that said, the best results come when divergence is spotted on the higher time frames, such as a 4-hour chart or higher. One of the most common mistakes often made with divergence trading is that traders expect the price to behave in a certain way when it's having a divergence is spotted. And now that is wrong because if you see divergence on, say, a 5-minute chart, but it's not being confirmed on those higher time frames, it could be just a spot of divergence and not an overall trend of divergence. Just because divergence is formed doesn't mean that the price action will reverse. Now, we touched on this a little bit earlier, but let's talk about the types of divergence. So there are four types of divergence, which are broadly classified into two categories. You got regular or classic divergence, and you have hidden divergence. With each of these two categories, you have a bullish or bearish divergence inside of them. Therefore, the four types of divergence are summarized as regular bullish, regular bearish, hidden bullish, or hidden bearish. And we talked about this earlier, but I have a real good chart that really breaks it down here in just a second. This chart right here is a fantastic chart, and it gives you a quick overview on the four types of divergence. Let's go ahead and focus in on the left side of the chart first. Here, this is giving you a good example of Class A, Class B, and Class C, both with a bearish and bullish divergence idea of what the price action is doing and correlating it to the oscillator in the bottom. These are your hidden divergence. And again, great examples of Class A, Class B, and Class C, both with price action and the oscillator correlation. And I suggest that you guys pay attention to this chart, do a Google research, find this chart, and keep this handy, especially as you're training divergence, so you can get used to your eye seeing what you're actually trying to figure out in correlation to divergence when you're making price movements and trade decisions. Now, the next two charts will show examples of the four types of divergence that occur on the price action chart and give you a better understanding of how it looks real time, sorta, when you're looking at a chart from a bird's eye view approach time frame. Here we can see a longer time frame, and you can see multiple areas where divergence is present on the price action correlating to the oscillator and giving you guys understanding of some great movements where you could make some very good money following the divergence. Here you can see a great example of hidden bearish divergence and the following downtrend that happens, regular bullish divergence, and an uptrend that happens shortly after, hidden bearish divergence, and we get a nice little downtrend that comes after it. And you have regular bearish divergence with a dump after. And these are what we're looking for. We want these dramatic shifts in the price action so we can make some serious capital. And then, of course, you're catching that regular bullish divergence with a nice push to the upside, making this a great example of a round trip trade with multiple angles of attack, going short, going long, going short, going long, and capitalizing on all of it to make some serious money. Now, in this example, you have regular bearish divergence going into a dump, where then we get that bullish divergence trace off of that so that we can play the other side, creating great pockets of profitability. Hidden bullish divergence with a big push to the upside, usually associated with a gap up. And then regular bearish divergence showing a decline where we can ride it down for some short trades. All right, so that's about all I got for you. So in conclusion, spotting divergence takes time and it does not expect results overnight. The best way to get started when spotting divergence is to utilize a custom divergence indicator, and all your platforms that you trade off of usually have some sort of form of this. In terms of which oscillator to utilize, the RSI is basically the king for newer investors when you're starting to go into divergence trading. MACD is another great one, but RSI would be optimal for newer investors to start training that eye so that you can spot divergence. All you got to do is simply switch to a price chart with the line chart and then add the RSI, which makes for an easy way to train your eye. And the chart that works the best is just your regular candlestick chart. If you guys are using some other form of it, try to look for the candlesticks, and you can see how price action really differentiates with divergence in the oscillator. That's it, team. Don't forget, Traders War Room is your one-stop shop. Try our TWR one-to-one mentoring. Does the market have you feeling like this, or wanting to rip your hair out while you watch your account dwindle? If that's you, then Traders War Room has you covered. Our one-to-ones focus on you as a trader or investor. The Zoom session connects you with a TWR professional. Whether we're covering charts, developing a plan of attack, or being strategic and deep diving on the how, why, and execution of trade plans. TWR one-to-ones will give you the confidence to attack, conquer, destroy, and make the market bend the knee in 2023. Join TWR and bow to no one. Book your session today. The link is in the description or on the website at traderswarroom.com. Let's go to war. TWR War Room Trading University is happy to announce open registration for our next option fundamental course. Did Wall Street make you feel like a complete loser in 2022? Or was everything going great and you blinked just for a split second and got repeatedly kicked in the you-know-what over and over again? TWR is here to help you. Our university's fundamental course is an in-depth 5-week-long course that's done live via Zoom platform. Our virtual classroom is where you can interact with the instructor, other students, or see copies of the classes right there on the platform, and rivals that of traditional online education. Testimonials from previous class graduates are proof that our cradle-to-the-grave approach works in giving you consistently profitable skills to trade options. Registration is open today. Links are in the description, or go to traderswarroom.com. I will see you there. Let's go to war. Make the market bend the knee in 2023. Join TWR and bow to no one. The link is in the description or on the website at traderswarroom.com. Let's go to war.